Hi, everyone. Welcome back to the Investipal podcast. I'm thrilled to bring on Doug Fritz today. Doug is the co-founder and executive chairman of F2 Strategy, the leading wealth tech consulting firm in North America. After a career as a CTO and technology leader at large institutions like Credit Suisse, Wells Fargo, and First Republic, Doug launched F2 in 2016, building a powerhouse that now helps leaders across RIAs, family offices, banks, and trust groups make smarter technology, data, and M&A decisions. Doug, thank you so much for coming on today.
Thanks, Cameron, for having me. Excited about this.
So maybe to kick things off, I'm curious, we always like to start off with a little on your background and how you got to build F2, what enabled that?
Yeah, I think I feel much more aligned to the folks that sort of grow up in large wealth firms and have increasingly executive roles and sort of reach the stage where their level of accountability for outcomes grows to like the C level. That was my track. But along that track, where I did most of my career was between the business strategy and the technology implementation of it. I think I started doing trade settlement for Credit Suisse in international equities, but quickly got into like accounting system projects and realized like, oh, this is kind of fun. I get to like work behind the scenes. But through that entire business and technology interplay roles, started to see that the people that I would be hiring from outside of my company to help us with strategy or implementation or giving us options and just supporting us. Very few. This is what was surprising. Very few had ever worked in the industry they were advising, and I think I was just having not quite tears and beers conversation, but sort of kvetching with my CTO peers. And I think we sort of collectively we're talking about like who's the best of the people that don't know much about our industry. And I think I might have been me, might have been someone else. Said like we should start a consulting firm. Like we should have a consulting firm full of people who actually know the details. Like I would hire that firm. And they're all like, yeah, we would hire that firm. And so I think I was either the one that wasn't smart enough to realize it was going to be a lot of work, or the one that had like enough emotional energy to go build a company around it. But that's the idea was, can you have a consulting firm full of people who truly know the detailed details of the industry because they've done it? And there's a great difference between the theoretical or the academic versions of what our industry is supposed to be, and then the tactical, actual, on the ground, day in, day out knife fight of getting new technology implemented or changes made. That is valuable to have a partner like that. And that was why we started F2. And weirdly, 9 years later, that's really who we're continuing to be.
I love that. It's funny. I came in from like an asset manager, sell side, like capital markets background. I worked or advised wealth managers before I launched Investipal, but I thought I knew what I knew until you actually get in, especially on like the portfolio management side, on like how you think about things on a asset manager level versus like how a wealth manager thinks more on like client goals and financial planning. On that note, I'm curious, like, the gap that you found early on with F2, is that now been solved for not just with F2, but the industry adopting a lot more wealth-oriented consulting firms in the market?
I don't think so. I think we're competing. F2 now competes against the largest multidisciplinary consulting firms in the country. That's our primary. If we're going to go up against another firm, we're going up against the big brands, and it's super clear. Like when F2 shows up in the room and we talk about the details of the project, it's very very clear to our prospects and our clients like where that difference is. Um, there are newer firms that have started that are smaller. I think F2 started with the idea that we wanted to be an institutional firm. Like it was weird to say that 9 years ago, but we always had the vision that we wanted to be not just a lifestyle company, but we wanted to fundamentally create a different consulting business, like a different option, a very clear different option than what was available for large enterprises. We haven't seen anybody else come close to our size. We also have a PE backer, so we're also inorganically growing and acquiring other capabilities pretty actively. We just closed our fourth this last few weeks. But I'd say what was helped, if anything, it helped and maybe hurt a little bit, is that the the prospects and clients are thinking about technology and they're hiring really good experts internally. And it's hard to say that, like, as a bunch of former CTOs and wealth executives, that the one thing that's maybe not um, like, in a perfect world, they're just hiring us all the time. That's not realistic. Our clients are hiring really good technologists and they're paying them really well. Um, and I love that. I gotta love it. We're in it for the folks that used to be us at the large firms. And so when the good teams, the good people win and they get good roles at great firms, I think we applaud that louder than anybody else. Because the impact that an individual that truly understands the industry and technology and advisor persona and client persona can be effective at leading change. I would argue that in 2025 and for the next 5 years, the quality of the CTO or maybe the COO in some cases has a far more impact to the success of that firm than any of the other C-level roles. And so probably happy to have that, but from a competitive standpoint, it's our clients hiring professional people inside where we've historically been that.
So on that last note there, do you think, the role of the COO or the CTO taking more of the limelight is due to AI entering the space and it being more involved in those advisors' day-to-day processes?
Now, I think AI is like chapter 10 in a book about why this has become more important. Operational efficiency, scaling up of these firms to be able to take on and deploy more external capital for inorganic growth. Expectations of clients dramatically increasing. The lack of tolerance for time wasting, wet signatures or repeated questions from multiple places in that firm asking the same information over and over and over again. Like, clients just have far less, and investors have far less tolerance or just patience for wasting their time. And so technology and investing in technology and getting good people to come in and run the technology and the operations of the firm has been increasingly important for the last 10 years. So I don't think, AI is just another great reason why you need quality people in your organization or partners like F2 to help you. But it isn't, I don't think it's initiating a level of urgency. Interestingly, those that have already bought in on the fact that technology is a critical part of their long-term growth and viability of the firm are those that are adopting AI. The firms that are, there's classes of firms like the bank trust space we specifically call out in our research. The level of adoption of AI there mirrors level of adoption of process automation, cloud computing, data as an asset. That just fundamentally the philosophy of the bank wealth management organization is to tamp down on technology spend as much as possible. And we're seeing results of that same sort of misplaced thinking over and over and over again. It's interesting because about half our revenue comes to the bank trust space, half of our revenue comes from the RIA or the advisory space. To see two different, theoretically, as an investor, these should look the same, but the construct and the experience and the level of technical acumen of the two different groups of firms it's like 5 to 7 years different now. And I think that it's just accelerating. The RIAs and the advisory firms are accelerating their use of technology, and those experiences are going to eventually become detrimental to the bank trust space.
I was looking through one of the research reports you guys put out before this, and I thought it was actually a fascinating stat that was it the last 2 years AI adoption has gone from like 50% to almost three quarters, 75%. Is that primarily on like the meeting note takers, or is it getting more involved in that workflow now?
Yeah, meeting note takers and then operational efficiency. I think those are the two pieces that it's not surprising. I think from the inside, it's not surprising that firms that are AI firms that come to wealth management organizations and say, I'm going to be able to save your most expensive employees 90 minutes plus per client meeting, and then the cost is totally digestible versus the value. It's a no brainer. for people to use meeting note taking capabilities. The other one are the operational efficiency tools that compile account onboarding documentation or can review a prospect's RBC statement and talk about the current portfolio and fees and get you ready for a great first meeting to go win that. Like, you're saving time and you're creating better outcomes for your advisors and for your clients. It becomes very easy for people to sign up for that. If you go down a list of use cases that these advisory firms are interested in doing, the ones that fall below that are some of the things that we normally think about AI, like help me write communications to clients by using a large language model that just replicates my voice and talks to me. Yeah, interesting, but there's enough compliance and regulatory unknowns in the way of that people have been a little bit slower to adopt. Things like predictive analytics, where look at all my data, all my clients, and this massive brain of an AI bot, and tell me what we should be worrying about, or working on, or like what might come around and bite us, right? Like, very little interest in that right now, partly because what's required to make those things work, and then the ultimate benefit to the firm are a bit opaque, versus meeting note taking, which like save 90 minutes per client meeting. Like, that is very clear. It's a very clear value proposition. And then you go to some of the lesser known use cases, which I think people have thought would come earlier. I don't think they're going to come for a while. Kind of like the reason why robo advice hasn't necessarily taken off, is the automation of the portfolio construction, security selection, or product selection, implementation, and trading. Sort of that last mile delivery. There's so much regulatory question marks there that I think firms are very slow. Not that they won't ever go there, but there are so many other ways to deploy AI that makes such an impact on the business that the current set of tools and capabilities and operational efficiency and like pulling information together for a client meeting, so much value there that easily for the next 5 years, we're going to see a lot of progress in that area, and we're going to see slower adoption of some of the more regulated, more contentious, I'll say, areas of AI.
Yeah, I'm grinning because like that's the area we end up playing, and what I've noticed, when we pitch like AI portfolio construction or filling the role of like a CFA on the team, it's not usually with the advisor. It's usually with like the CIO or the portfolio consulting teams. I'm curious your thoughts on the different parts of the organization and how they're adopting it. Like boots on the ground, totally get the note taker, but are you seeing with some of the other parts of the organization looking for where note taking is not as prevalent or needed? They're looking for that
Yeah.
helping hand.
Yeah, I think some of the we're seeing it in like product selection review, where look through. I saw a note on like the number of alternative investments, sort of the non-liquid investments. There are more um, venture PE hedge funds than there are Starbucks in the world, and there's just so many. And then the details behind them are so written down. They're not really. It's not like you can do a versus benchmark comparison of one model or one security versus another one. These are very opaque. And so AI that can read through that and provide actionable qualitative information about which assets to select for your clients, or give you insights that you don't have to read or spend hundreds of thousands of dollars on an outside IO to review. Real value there. Every year, like tech spend at every wealth firm goes through an annual review cycle. And usually there are themes that the firm is trying to hit. In 2025, those themes are efficiency, client engagement, right? And now organic growth. Those are really, really big. I think we see a market correction, and I've been around long enough to see several market corrections. Compliance and oversight and like rigor on a process often follows immediately after a large market downturn. And so it's more a matter of like when some of these things are going to get picked up by the compliance team or the trading team or the due diligence teams. It just right now, everyone's going after growth. Everyone's going after marketing. Everyone's going after being competitive in the space to win more client mandates. That tail will switch to the other side, and it'll become all compliance, all locking down, all analyzing data. It's just where we are in this cycle.
Do you think, yeah, even with that, with the deregulation that the U.S. government's calling for right now, it'll still fit the bill, or it'll get pushed out?
Man, good question. I think there's some things like Reg BI in the states that have been held out as this standard we were going to adopt. It didn't happen under the previous administration. It sure is not going to happen under this administration. People have to make decisions that are going to last multiple executive leadership, right? So I don't see any firms significantly changing course with this or loosening up or contracting the type of regulation they're going after because of what administration. Whatever you do under this administration, if the next administration comes back and says, no, we're going to interpret this differently, you're accountable for 4 years of what you were doing under a previous administration. So we're pretty conservative. I think most people in this industry, also in the states anyway, know that there's multiple generations of a norm. Even if things are allowed, folks aren't going to step over that line very much.
So where do you think there's the compliance risk as being hesitancy to adopting AI, but like, why do you think the bank trusts are slow there? Is it they're just too human?
Yeah. So I grew up in the bank trust land. So, I know more about, Wyoming trust regulations than anybody at 51 years old should ever have to know about. That didn't work as a trust officer. Fundamentally, it comes down to how those organizations philosophically measure success. And we have this lovely person called Warren Buffett, and Warren Buffett's a big investor in banks, and the legacy of the methodology of investing in financial organizations is this efficiency ratio concept. How much of the return of capital generated by the organization is returned back to the shareholders, right? And so the more we're returning to shareholders, the better, more healthy that firm is, the more apt that it's going to get picked up by investors like Warren Buffett. If you think about that as a concept, that the more I can return capital to shareholders, the better I am. It foregoes a massive component of innovation. And there are people that would say, no, Doug, you're wrong. Innovation's about future returns. That may be. But when it comes to budgeting and expanding spend on technology, that may or may not have an impact to that organization in the next 12 to 24 months, it's seen as an expense to be reduced, versus the RIAs that don't have that sort of efficiency ratio as a moniker. They have growth, they have value, they have margin, but efficiency ratio is not really a measure of success in the RIA and the broker-dealer space. They see technology spend as an unfair advantage they can create for themselves and their brand in a marketplace. It is not something that the banks think about at all. I have not worked with any bank that thinks, maybe except for one, that thinks that their technology is an unfair advantage versus their competitors. And even if they did believe that in the wealth space, the banking leadership still has an efficiency ratio concept that is going to try to reduce as much as possible how much money they're spending on technology. And it compounds. So in an RIA, for example, between 7 and 9% of return 7 and 9% of the revenue generated by that organization is earmarked for technology spend. And that's about twice as much as it was when F2 started 9 years ago. In the bank trust space, it's like 2 to 4% of revenue, so it's less than half in some cases. It compounds. If you're not spending what you should be spending to be competitive in the marketplace for 1 year, that's bad. You've got next year to make it up. You talk about decades of underinvestment. And what you see is, things like account opening times, taking, open fund, start charging a fee on that relationship and start doing things to that portfolio could take weeks and weeks and weeks. We have clients that measure account opening in like over a month to go from clients that want to work with you to that is set up, the money or the assets are moved over, and it's ready to be managed over a month. Our RIA clients are like 48 hours, sometimes less if it's just cash. And the gap between the tech and client experience and the advisor experience is clear in the growth rates. The bank trust space is effectively shrinking. Like a lot of their clients are, legacy trust assets that are being distributed. They're not winning as many new mandates. The new modern wealth creator that's driving our economy in the States, like they're not typically engaging with the bank trust portfolio manager. They're engaging with RIAs.
Do you think that RIA adoption of technology over the bank trusts is also due to M&A trends in the industry where they're trying to gear their business up to be sold and they want the juiciest
For
revenue
sure.
multiple?
No, 100%. M&A. So M&A has sort of two aspects, and it depends on what side of the coin you're on. If you are a $3 billion RIA or super OSJ or some form of advisory business, and you want to be the brand, right? This is my brand. I've got a cool thing that I want to build, and I'm gonna go get capital. You need technology, or at least a vision of technology, and a lot of our work is also to help firms like that build the vision of what they want to build and make sure that every dollar they spend is articulately delivered. You want to have the platform to acquire other businesses and be the foundation of the building. So technology is important to have that for capital. And we also work with PE firms that are investing in those firms to look at how ready for capital is that firm. Well, in some cases, it's like, well, they've got 10 different custodians, no unification of the data coming in. They've got some good vendors, but not integrated. They've got no workflow, and their CRM is like poorly adopted. Well, damn, that's like 18 months and $5 million worth of work to get it to be good, to be able to layer things on top of it. The PE firm takes that into account when they think about the valuation of the business. And then there's also technology for the firm that wants to sell to a platform. In that case, honestly, tech sort of important, but not as important, really. It's more about the efficiency of their business and how quickly with as low a headcount as possible, can they achieve high EBITDA numbers. They don't have to be a platform. They just have to be really good at what the clients are working with. They have to show a fast growth rate. Then technology is going to be more about like marketing, branding, growth, wallet share, expansion. We can grow within our current client base. They can prove a story that the people in that firm are capable of continuing to grow, and they can join another firm and be contributors to their growth. So it's still technology, but it's less fundamental platform, long-term thinking technology, more tactical. Let's use tech to show a spiking in the growth rate of our business.
Okay, very interesting. And so on that note, when with the adoption of AI within an organization now, I forget who it was. It was like Morgan, one of the wirehouses who is kind of leading the charge. But the way that they've been doing it is their backend developers leveraging AI tools like a Cursor or whatnot to help with that development. Are you seeing a shift away from buying into firms building out their own proprietary stacks?
Yeah. So it's kind of like you got like salt water and fresh water, and then there are some places in the world they mix. And so for the vast majority of advisory businesses in the States, about 15,000 roughly advisory businesses in the States, not including bank wealth management, just RIAs. And there's like 10 to 20 really big ones. And then in Canada, it's sort of
5.
It's like the longer tail, but like more of the market is managed by the larger RBCs and Scotias. In the US, we still have like large firms that have their own, and they're investing in their own AI people, right? So they're hiring great AI engineers and data engineers. They're going to build it themselves because frankly, they can get better outcome, and they're also creating muscle memory of their own organization on how to use these tools to continue to be basically their unfair advantage against smaller, faster moving firms. And I love that. Big firms have a reason for being around. We work with both big firms and small firms. And sometimes big firms can't get out of their own way, right? They just do stupid things. They make bad bets on technology. They make bad bets on hiring consulting firms. They don't know what they're talking about. So when they have an unfair advantage they can use, like their scale, that's good. They should use that. They should become great at using AI. If you're a smaller firm, though, if you're one of these smaller $10 billion, $20 billion RIA firms, it's very hard for me to justify hiring an AI expert in that organization. It's going to be like one person, and she's going to know, what she knows. But it's not going to be like materially driving the value of the firm. It's not like into the culture of the organization. And it's, the results are going to be based upon what one person probably can do. It's hard to see that like the work of that one person, like covering the cost and the risk of having that person be there. And so they're going to rely on vendors at the smaller side. So big firms working with it mostly internally with some vendor stuff, but they're building out their own capabilities. Smaller firms are leveraging vendors. And then where I mentioned before, like where the C's meet, is really interesting, right? Where firms are getting big enough to start thinking about having their own people. Then how do you start your own, data science group, your own analytics group, your own, AI and prompt engineering group? To what extent, and how much are you going to invest there? When do you start taking it seriously?
Mm-hmm.
We're starting to see little kernels of that happening, where mid-sized firms are starting to act more and more like larger firms, and how much should they be working in that area? If those $200 billion wealth shops are going to be $1 trillion wealth shops in 10 years, maybe they need to be investing like the big guys, doing it more intelligently, like without a lot of the bureaucracy and, conflict that happens in larger organizations. But that middle estuary is fascinating. Where people are starting to go from vendor to taking things in house.
Do you think like in that middle part there that they're moving away from wealth tech oriented vendors to like working directly with like a cloud provider, like a Google Cloud or an Azure, to co-develop that out?
Uh, um, for sure, they're going to work with outside entities where that is, where it's not critical for them to have that knowledge and build that muscle memory. But there are things that they should. And I'm not saying everybody does the right thing. They should be maintaining ownership and muscle memory around the things that are going to help them drive value out of these tools in the next 10 years. So this cloud infrastructure, like it's commoditized. It's not really something that they necessarily have to be great at. Um, the what I really see that's interesting here is where AI is starting to shake up what even our tools are, right? So the big one that the CTOs, and we have a 215 of top CTOs that drive our research, and a lot of our things we do are based on evidence from the industry, is real questions about the future of the CRM and of the advisor desktop. And so with AI that can effectively pull relevant real-time insights and tasks and things to be paid attention to, as well as data and insights, and can be agentic in what it's doing so that it doesn't have to be told to go through 10 different steps. It knows which steps to proceed through. That sounds a lot like a really well-designed CRM, right? Or a really well-designed advisor desktop. And so it'll probably come together. Like, I hate when people try to doomsday, sky is falling and some technology is going to overcome some other big part of our technology. I don't know what's going to happen, but if I had $1 million tech budget right now, I'd probably be spending more of it on the agentic AI apps and components than I would be on configuring my CRM to ultimately do what the agentic stuff's going to do in a couple of years anyway. So our clients are spending more money on AI now than on really digging into developing out their Salesforce instance.
Yeah, I mean that makes total sense. Like when I had a brief stint doing sales operations at another company, and wrangling the sales team to insert information into the CRM is always a losing battle. I could see, the note taker joins the calls, puts all that information directly to a CRM entry. It could follow up with you to ask for more information or when it's timely. And that's essentially that digital CRM or an agentic CRM where I'm interacting with it via chat versus logging into a dashboard and seeing everything at a glance.
100%. Yeah.
Is there, so, in the next 2 to 3 years, is that where you see the big change in the industry coming from? Is like the agent workforce coming into the foray?
For sure. Yeah. It's there is an undeniable and almost like irresistible urge to let the tools do things that humans don't think that they're adding on. It's where the client value add. Like, I don't think we're going to have AI talking to our clients. I think that's something that I don't think we're going to see that. I think that the operational efficiency and then taking information that we have that currently is impossible for any one human being to ingest, make meaning of, and get prepared to communicate to our clients. AI is fantastic at that. Like if you can imagine if, an advisor has 100, 120 clients in the US, kind of averages depend upon the, the level and complexity of investments. I call it 100 clients. For me to know everything about 100 clients, about what's going on, their companies they work for, where they are in their lives, where they are in their families, going to college, their parents passing away, their clients' parents passing away, things that are happening. You keep that in my mind, and then provide a increasing stream of value about the markets and the portfolio, and how these changes we can reflect in what we're doing, and how you're okay, you're not okay, you got to worry about something, or tasks that are not completed. It's almost impossible. Single family offices do it because they have enough wealth that 100 million, $200 million family can afford to have someone just, a team just focusing on their wealth. In regular advisory firms with, advisors that have 100 clients, it's impossible. But AI amazingly can get us so close to that type of an experience because it's on all the time. It's constantly looking at things. It's looking at what we could talk to our clients about, what we're doing well, what our clients need to be thinking about or doing. And it gives us this vehicle to make, even though I'm one of 100, it makes me feel like I'm my advisor's only client. And that's great. It's great for our industry for sure. It's also going to help us overcome a little bit of what the sort of, not soon, but over the next 10 years, we're going to face an advisor shortage, or we're not going to have enough advisors to take the place of the current advisor sets. Well, what if we can manage 200 clients effectively, right? Where now I'm doing managing twice as many clients. I'm doing as good a job or better job than I was doing managing 100 clients without the AI. It's fantastic. It's like, it's going to help us manage more clients better. It'll cut off the angle of this problem around not having a new crop of advisors joining the industry.
Yeah, I love that. I know, like, I could probably pick your brain the entire rest of the afternoon on this topic, but maybe we'll pause it there. I'd love to have you back in the future.
We'll love it.
And Doug, if anyone's interested in learning more about F2 or following along with you, what's the best place they could connect with you over?
So for sure, hit me up on LinkedIn. I think I am open to any and all folks just to connect on LinkedIn. I'm always happy for individual questions. I get a lot of questions like, "Hey, I heard you on a podcast. What do you think about fill in the blank?" I check my LinkedIn messaging. I'm usually pretty good at getting back to people. I think about learning about F2. It's a couple of things. One is go to our website. There's an actual. You can follow us on LinkedIn as well as a company. We have almost daily, we have research and insights that are coming out from our work and our research that's just designed to be helpful. But we also have a monthly consolidated newsletter of like all the things that are going on in the industry. It's just sort of consolidated, made it easy to just spoon feed what's happening. And then if they really are, hey, I think I need to talk to a consultant that really understands the industry, understands what we're talking about, and I want to, engage. There's a simple, it's on the website, but it's like hello@f2strategy.com. I get that, by the way. So I and my executive team get it. We always respond within like 3 hours. So we'll set up some time to have a conversation.
Okay, wonderful. Yeah, we'll leave a link to the show notes as well for anyone who's interested in connecting with Doug. Doug, thank you so much for coming on.
Awesome. Cameron, thanks so much for having me.